Hey guys, in this video I'll be analyzing Facebook stock, so if you guys want to know my opinion and if I'll be buying this company in my M1 finance portfolio, so make sure you stick around to the end to hear the final verdict. Before we jump into the analysis of Facebook, I'm going to give a quick channel update. We're almost at 200 subscribers, so if you guys enjoy the video, watch another video to make sure I didn't just get lucky with this one, and then subscribe to the channel for more videos about investing. Also, I'm going to leave another comment below so you guys can vote on the stock that you guys want to see next. So make sure you leave a comment on the thread if you care about what video I release next. And last, in the previous video on Starbucks, I mentioned that I'm probably going to start a new series where I give updates on my current dividend portfolio, give my opinion on current stock market news, and answer your questions. I'm happy to say that I will be doing that, so ask questions in the comments below. Even if you think it's stupid, I'll probably answer it. Thanks for sitting through that, guys. Now let's jump into the analysis of Facebook stock. I know I say this in a lot of videos, and honestly, probably all of them so far, but I don't think there's a person who has access to my videos that doesn't know about Facebook the platform. But I'm sure not everyone knows exactly how Facebook the company makes money or all the business units that they have. So Facebook is basically an advertising company. They offer free services like Facebook, Instagram, Facebook Messenger, and WhatsApp. And because there are so many people using their platforms, advertising agencies and companies give Facebook money to showcase their company or product. Essentially, it's the same business model as Google, except Google shows ads when you use their products to search online, and Facebook shows ads when you use their product to connect with friends and watch the endless videos on their platform. In addition to their social media platforms, they also own Oculus, who designs and manufactures hardware for virtual reality experiences. So, since revenue makes up over 95% of their business, that's what we'll look at first. Now there's a shift that's been occurring over the past 5 to 10 years that companies like Facebook are really benefiting from. Advertising agencies and marketers for companies are increasing the percentage of their budget that they spend on online advertising. Before this, the most prevalent ways to advertise has been a struggle between radio, print, like newspapers and magazines, and television. But in 2019, eMarketer released their estimates, and for the first time ever, digital advertising spend would surpass offline advertising, those other ones that I just mentioned. They also estimated that by 2023, digital advertising spend would make up about 2/3 of all advertising. Furthermore, the rates that these online advertisers are charging has been increasing as well. If you look at the chart on the screen right now, you can see the average CPM of each advertising medium. CPM is a way to tell how much it would cost you to get your ad seen by 1,000 people. And as you can see from the chart, social media advertising is incredibly cheap in comparison, which is why it's growing so fast. But over time, these numbers will get closer together. TV advertisers won't be able to charge so much because they're losing customers, and social media will be able to charge higher prices because they'll still be the cheapest game in town. So, investing in this industry is super attractive, because almost everything is moving in Facebook's favor. But being in a good market is only valuable if you're able to command and sustain a good market share. Luckily for Facebook, they have a dominant position, and it's actually been improving over the last couple years. If you look at the graphic on screen, you can see all the major online advertisers in 2019 ranked by revenue. As you would expect, Google's number one by a pretty good margin, but then there's Facebook. I think over time these two will be at the top together, and Amazon will be closely behind them. But Google and Facebook eventually should be able to maintain at least 25% of all advertising each, which when the market is growing so fast will allow them to both grow super quickly. However, Facebook is going to grow much quicker. Now let's take a look at what this favorable environment has allowed Facebook to do. Facebook has been able to grow their revenues every year since they became a public company in 2007. And over the past 5 years, they've grown revenues at an annualized rate of 36% every year, and over quadrupling their revenues in that same time period. Furthermore, they're expected to grow well into the future. According to Yahoo Finance, analysts expect Facebook to grow by over 13% every year for the next 5 years. So in 5 years, Facebook will go from revenues of $71 billion to $131 billion. That's almost double what they're producing right now. And outside of strict revenue numbers, their platforms have also been growing very well. In their most recent earnings report, they showed monthly active users of 2.6 billion people, which is 10% higher than they had over the previous year in 2019. Now, it wouldn't be a video about Facebook stock if we didn't talk about their privacy issues with the Cambridge Analytica situation. For those who aren't familiar, there was oversight on Facebook's part that allowed an outside marketing analytics firm to get more data about the users of Facebook than they were comfortable with. Since then, Facebook has taken all the correct steps to correct this mistake and repair their image. They invested heavily into their privacy and data security staff, which is a big reason why 2019 net income was lower than 2018. They've also made sure that the public is aware that they've made these improvements, which allows their customers to feel safer using their products. And honestly, this may be a controversial opinion, but I think the data shows that even though people say privacy is a big issue for them, they act as if it's a minor thing. I think people implicitly understand that if a service you are using is free, then you are the product. And really most people are fine with that to a certain extent. So moving forward, I think the investment Facebook has made will be a great defense against possible regulation. And it sets them apart from other social media platforms like Twitter and Snapchat, because they have built great infrastructure to deal with these issues if they arise. Now, if nothing I've said in this video has convinced you one way or the other, I'm sure their balance sheet strength will. At the risk of sounding hyperbolic, I think Facebook has the best balance sheet I've ever seen. They're currently sitting on $55 billion in cash, which is enough to completely buy Snapchat and Twitter if they wanted to. Not only is the amount of cash that they have incredible, but they also have no debt. If Mark Zuckerberg woke up tomorrow and decided that he didn't want Facebook to owe anybody a single penny, I don't know, maybe he was watching too much Dave Ramsey, then he could pay everything off and still have enough left over to buy Twitter. Now, buying companies is great, but what this cash reserve really does is it gives them the safety that a lot of companies are really lacking right now. Many companies are insolvent right now because they paid too much out in dividends and bought too many shares back. But Facebook could be taken offline for years and still probably have enough cash to keep everything running the same as before and then come back just as strong. And that's why assessing the balance sheet of a company is so important. It shows you how well they can really weather the storms of economic downturns, business cycle shifts, consumer demand shifts, or anything that can really put a company into bankruptcy. If you have this cash going into that situation, you're probably going to come out of it all right. Now, right now, Facebook is trading with a share price of just above $200, which gives them a PE ratio of about 28. Usually, I try to pick up companies with PE ratios below 20. However, companies like Facebook who are growing so fast and in such a booming industry require that you pay a little bit more, and I'm okay with that. Facebook doesn't currently pay a dividend, which is a negative, since the goal of this channel is to look at investments from the view of a dividend investor. However, I think it's good for everybody to know that just because you are a quote-unquote dividend investor, not every company you invest in has to pay a dividend. The labels that people put on their style of investing really shouldn't be that rigid, because the reason I call myself a dividend investor is because it shows people what I value higher in investments, but it's not the only thing I value. If you've made it to this point in the video, I'm sure you can guess my opinion on this company. Also, you're the best for watching the whole video, so give it a like. I absolutely love this stock. I own a good amount of shares in my Roth IRA, and it's actually one of my longest held investments, since I've owned Facebook for at least a few years. So, with all that said, even though they don't currently pay a dividend, I'll be purchasing $250 worth of Facebook in my M1 Finance dividend portfolio. Now remember to leave a comment for which stock you want to see analyzed next, and any questions you have for me that I can respond to in my upcoming series. As always, thanks for watching.